All right, let's get right into it. We are opening an investigation into something absolutely wild that just went down in the precious metals market. It was fast, it was brutal, and honestly, it left a lot of people scratching their heads wondering, what on earth just happened? In this explainer, we're going to get to the bottom of it.
This is our crime scene. In just one day, the price of silver didn't just drop, it completely fell off a cliff, down a staggering 27%. That is a historic, unbelievable move that just vaporized fortunes in a matter of hours.
And look, it wasn't just silver. Gold got dragged down with it, taking a 12% nosedive. We're talking about trillions of dollars in value just gone. The shockwaves from this thing were felt across the entire global financial system.
So this brings us to the big question, right? The one at the heart of our investigation. Was this just a crazy, volatile day in the market? A perfect storm of bad news hitting all at once? Or, as our source material suggests, was there something more deliberate at play here? A coordinated takedown?
So here's our roadmap. This is how we're going to crack this case. We'll start with the official story, the one you hear on the news. Then we're going to peel back the layers and look at a hidden culprit. We'll examine this really strange disconnect in the market, see what history can tell us, and then, most importantly, we'll finish with a clear action plan for you.
Okay, so let's start by looking at the official narrative. These are the four main reasons you'll hear in the mainstream media that supposedly explain this massive crash. Let's just call them the usual suspects.
The official story, it kind of goes like this. It's built on four pillars. First, a suddenly strong US dollar. Second, signals from the Federal Reserve that have planned to keep interest rates high, what they call a hawkish stance. Third, a manufacturing slowdown in China. And finally, just good old-fashioned profit-taking after a huge run-up. And on the surface, they all seem pretty plausible.
This right here is classic market stuff, the seesaw effect. Gold and silver are priced in dollars, right? So when the dollar gets stronger, it just takes fewer of them to buy an ounce of metal, so the price of metal goes down. The dollar index shot up right before this, putting immediate pressure on metals. It's a fundamental relationship a lot of people forget about.
But here's the kicker. Why did silver get hit more than twice as hard as gold? Well, the answer seems to lie in China. See, gold is mostly a monetary metal, a store of value. But silver is a crucial industrial metal. It's in everything: solar panels, EVs, electronics. So when China's manufacturing data came out looking weak, it signaled a way lower demand for industrial stuff, and that hit silver's price directly, and a whole lot harder than gold's.
Okay, but that official story, it just doesn't sit right with everyone. And this brings us to the core argument of our source material, the hidden culprit that might have turned a normal market dip into an absolute all-out crash.
This could be the smoking gun. The CME Group, that's the big exchange where silver futures are traded, they raised margin requirements. That's the cash traders have to put up to hold their positions. Not once, not twice, but 4 separate times in just 6 weeks. Now, the exchange will tell you this is to reduce volatility, but the effect can be a death spiral of forced selling.
To really get what this feels like, think about it like this. Imagine your landlord doubles your rent. Overnight. You scramble, maybe you borrow some cash, but you pay it. Then, a week later, he raises it again. And then again. At some point, you just can't do it anymore. You don't have the money. You have no choice. You have to pack your bags and get out. You've been priced out.
In the trading world, that eviction has a name. It's called a forced liquidation. When margin requirements shoot up like that, traders who are using leverage, borrowed money, and don't have tons of extra cash sitting around are forced to sell their positions. They don't have a choice. This flood of forced selling just swamps the market, and the price absolutely craters.
And if you think that's strange, the plot thickens even more when we look away from the computer screens. Because while the price of paper silver contracts was crashing and burning, a completely different story was unfolding in the real world of physical metal.
You've got this totally bizarre disconnect. On one hand, the paper market on the screen is screaming that there's a massive glut of silver with prices in total freefall. But at the same time, in the physical market, major mints are literally suspending sales and reports of shortages are coming in from everywhere. How can both of those things be true at the same time?
And listen, these aren't just rumors. We're talking about the Perth Mint in Australia, the US Mint, the Royal Mint in the UK, all of them either suspended or limited sales. We saw huge withdrawals from vaults in Shanghai and heard reports of dealers in India actually unable to deliver the physical metal they'd already sold. The physical market was screaming scarcity, while the paper market screamed abundance. It just doesn't add up.
So, with all this conflicting evidence, where does this leave us?
Well, to try and figure out what might happen next, we have to look back. Let's see if history can give us any clues.
You see, the massive run-up in price right before this crash was incredibly rare. A gain this big, this fast, has only happened 2 other times in the last half-century, once back in 1974 and then again in 1979. So the big question is, what happened after the crash in those 2 cases?
And what's fascinating is that history gives us 2 very, very different playbooks. After the '74 crash, the market basically went sideways. For 5 years, it just consolidated. But after the '79 crash, there was this huge, sharp 35 to 40% rebound, followed by an even bigger crash. So the million-dollar question for every investor right now is, which path are we on?
Okay, so we've laid out the crime scene, we've looked at the suspects, we've even checked the history books. Given all this, given these 2 potential futures, what should an investor actually do right now? Let's break down an actionable plan.
And this isn't a one-size-fits-all situation. The source material breaks this down for 3 very different types of people. You've got the long-term physical holder, the short-term leverage trader, and the new investor who's maybe seeing an opportunity here.
First up, if you're holding physical metal, like coins or bars, the advice from the source is incredibly simple. Do nothing. Just sit tight. Your position is meant to be long-term financial insurance, not a short-term trade. The crazy price you see on the screen is just noise. The fundamental reasons you own that metal haven't changed one bit.
Now, for traders using leverage, and that just means borrowed money to make bigger bets, listen up. This whole event is a massive wake-up call. In a volatile market like this, our source describes leverage as a death sentence. The advice is blunt. Immediately cut down your position to a size that you are genuinely 100% comfortable losing. This is all about survival.
And finally, for new investors, the people looking at this from the outside, this could be an opportunity. You know that old saying, the time to buy is when there's blood in the streets. But, and this is a big but, the key is to be smart about it. Don't go all in at once. The advice is to consider buying this dip in stages or tranches to average out your purchase price.
And really, that brings us to our final thought, which is summed up perfectly by this quote. In moments of pure panic and chaos like this one, the people who let their emotions drive their decisions, they're often the ones who end up selling at the bottom, providing a great deal for those who can stay calm, stay rational, and stick to their plan. The real question is, which one are you going to be?